Donald Trump yesterday said he was imposing 25% tariffs on all cars not made in the United States, but absolutely no tariff for cars built in the US. New tariffs were codified in a presidential proclamation signed in the Oval Office and which goes into effect on April 2, the day when other reciprocal tariffs are to be announced. China's industrial profits fell 0.3% from a year ago in the first 2 months of 2025 as the country faces trade tensions. Data released out today says profits at industrial firms are lower for 3 consecutive years, reinforcing calls to step up support for the economy. Hello, welcome to Global Business Insights, where we analyze the main business stories. The latest tariff headline sent Wall Street fleeing riskier stocks again. The risk-off mood dragged down especially by tech stocks, with Nasdaq down over 2%. General Motors shares slumped 8% in aftermarket trading. Shares in Ford and Chrysler parent Stellantis were down about 4.5% each. In Asia, shares in Toyota Motor, Honda and Hyundai all fell around 3%. In February, US durable goods orders rose 0.9% month over month, over the forecast for a 1% contraction. Core durable goods orders, that is excluding transportation, rose by 0.7% month over month, up from 0.1% in January and also above the 0.2% increase expected. Businesses rushed to avoid potential price increases from tariffs, likely boosting capital expenditure in the first quarter. The pound sterling faced selling pressures against major pairs after the Chancellor of the Exchequer, Reeves, unveiled her update. UK Chancellor Reeves delivered a spirited statement. The OBR had revised downward the UK's growth forecast for 2025 from 2% in the autumn to 1% today. She said, "I'm not satisfied with these numbers," adding that the government is serious about taking the action needed to grow our economy. She also says it's all about economic growth, more homes for families and good jobs. It was a positive spin to a difficult context at which many said it may not be exactly enough to deliver the improved growth so desperately needed in the United Kingdom.
There have been 3 interest rate cuts since the general election, and today's data showed that inflation fell in February. Having peaked at 11% under the previous government, the OBR forecast that CPI inflation will average 3.2% this year before falling rapidly to 2.1% in 2026 and meeting the 2% target from 2027 onwards, giving families and businesses the security that they need and providing our economy with the stable platform it needs to grow. Mr. Speaker, earlier this month, the OECD downgraded this year's growth forecast for every G7 economy, including the UK. And the OBR have today revised down our growth forecast for 2025, from 2% in the autumn to 1% today. I am not satisfied with these numbers, and that is why we on this side of the House are serious about taking the action needed to grow our economy. Backing the builders, not the blockers, with a 3rd runway at Heathrow Airport and the Planning and Infrastructure Bill. Increasing investment with reforms to our pension system and a new national wealth fund. And tearing down regulatory barriers in every sector of our economy. That is a serious plan for growth. That is a serious plan to improve living standards. That is a serious plan to renew our country.
According to an analyst, to sum it all up, the main growth theme in the spring statement is the boost in defense spending. This led to share prices of major listed defense stocks in the UK going up sharply, with BAE Systems, Rolls-Royce and Babcock shares all up 30 to 40% higher over the past few weeks. Sweden's prime minister also said that his country would raise defense spending from 2.4% of GDP to 3.5% by 2030. There is also support for the increase to be funded mostly by borrowing. US crude oil inventories fell last week as refiners ramped up production, while gasoline and distillate stockpiles also dropped. The EIA, that's Energy Information Administration, said crude inventories fell by 3.3 million barrels to 433.6 million barrels in the week ended March 21, compared with analysts' expectations for a 956,000 barrel draw. As supply tightened with sanctions on Iran and tariffs on Venezuelan oil buyers, Brent was up 1.1% at the end of yesterday, close to $74 a barrel. The International Monetary Fund has called for Senegal to streamline tax exemptions and phase out costly energy subsidies as part of urgent reforms after an audit revealed misreporting of economic data. The IMF suspended its existing $1.8 billion credit facility to Senegal, pending a review of state finances, which confirmed last month that the debt and budget deficits were much wider than was reported. Planning Minister Rania Al-Mashat says Egypt is signing a memorandum of understanding with the European Union on previously agreed financing worth 4 billion euros, about $4.3 billion, in the second half of the year. The financing is part of a 7.4 billion euro funding package agreed between Egypt and the European states to support Egypt's economy and limit future migration across the Mediterranean. Egypt's cabinet approved a 4.6 trillion Egyptian pound, that's about $91 billion state budget for the financial year that will begin in July as it continues to tighten its finances under an IMF program. The company developing Uganda's East African Crude Oil Pipeline, EACOP, has closed the first allocation of external financing from a syndicate of institutions, including commercial banks and Afrexim Bank. Uganda's energy minister said partners developing the $5 billion East African crude oil pipeline were injecting more cash into the project to prevent its stalling as debt financing proved elusive. Minister Ruth Nankabirwa had traveled to Beijing to meet with potential funders after several Western banks, including BNP Paribas, Societe Generale, and Barclays, pledged not to finance the pipeline under pressure from climate activists. European Commission President Ursula von der Leyen quickly criticized the new US tariffs, adding that the European Union will continue to seek negotiated solutions while safeguarding its economic interests. She also said tariffs were taxes and bad for businesses, worse for consumers equally in the US and the European Union. White House officials further clarified that the new tariffs will apply to foreign-made cars and light trucks and come in addition to duties that are already in place and will result in over $100 billion of new annual revenue to the US and much more in new investment as car makers ramp up capacity utilization within the country. Trump said there will be very strong policing on which parts of a car to hit with tariffs as cars come with parts made from places all over the world. Importers of automobiles under the USMCA will be given the opportunity to certify their US content so that only their non-US content is taxed. Auto stock shares after the announcement were all down roughly over 5% in extended trading. On April 2nd, reciprocal tariff plans are set to begin, and we understand they will be fair and lenient, which means even after considerable increase of US tariffs, they would still be materially lower than what the other country charges. There will be some countries like we saw with India reducing their taxes. But all in all, the cost of trade globally will go up, and we can expect at best a one-time inflationary effect. We also know there could be some exemptions following negotiations ahead of April 2nd. More than 7 million cars in 2024 were imported to the US, and 50% or more of the parts on many popular models assembled in the US come from Canada and Mexico. Trump also announced a plan to make car loan interest deductible from income taxes like mortgage interest, but only for cars made in the US. The president wants more cars made in the country, but it would take tens of billions in capital and several years to completely reorient North American production. Canadian Prime Minister Mark Carney said his government would use revenues raised from retaliatory tariffs to protect vulnerable workers and companies. The United Auto Workers Union, which represents factory workers at Big Three Detroit carmakers, are praising Trump's action. UAW President Shawn Fain said in a statement, with these tariffs, thousands of good-paying blue-collar auto jobs could be brought back to working class communities across the United States within a matter of months, simply by adding additional shifts or lines in a number of underutilized auto plants. But if other countries retaliate with their own tariffs on US assembled vehicles, this will force some US assembly plants to scale back their own production. Analysts think about 30% of North American auto production, or roughly 20,000 vehicles a day, could also be halted, assuming tariffs both on auto parts and assembled vehicles. We can also expect that negotiations can lead to exemptions and, like I said, reversals, as the president seems open to a better deal for America and Americans. Some of the mixed reactions coming in. The German Car Industry Association President Hildegard Müller, who says the announced US tariffs of 25% on all passenger cars and commercial vehicles that are not manufactured in the US are a fatal signal for free and rules-based trade. The German automotive industry is calling for immediate negotiations between the US and the EU on a bilateral agreement. The risk of a global trade conflict with negative consequences for the global economy and growth, prosperity, jobs, and consumer prices is high on all sides. And in the US, the National Foreign Trade Council, which represents many US companies, the Vice President Tiffany Smith says placing tariffs on imports of autos risks damaging the competitiveness and export readiness of an industry that relies on integrated international supply chains and markets for its success. Quoting Tiffany Smith, "We urge the administration to focus on the competitiveness of the US auto industry and prioritize market opening opportunities for auto companies who manufacture vehicles for export in the United States." Going forward, nothing seems off the table. For example, it was reported that Trump is willing to reduce tariffs on China to get a deal done with TikTok's Chinese parent ByteDance to sell the short video app used by 170 million Americans. Asia Pacific markets traded mixed, also tracking losses on Wall Street as investors digested the latest US 25% tariffs on auto imports. Japan and Brazil yesterday agreed to a 5-year action plan that covers exchanges in the area of political and economic dialogue, as well as climate issues. This was at a state visit by Brazilian President Lula da Silva to the Asian country, where this framework was agreed. Well, that's all on this episode of Global Business Insights. Thanks for watching. This is Buddy Ashosami.